REITs, or real estate investment trusts, are a great way to diversify your portfolio and a great way for regular people like you and me to gain access to real estate. If you look at some of the top billionaires in the world today, many of them have built their wealth through real estate. And there's two primary ways to invest in real estate. You can go buy rentals on your own, or you can invest in REITs. There's a lot of pros and cons to both. However, some of the cons with buying actual property is the fact that that money isn't very liquid. However, there are many great tax benefits. But when you buy REITs, number one, you don't need as much of a down payment. You just invest what you have. It's just like a stock, and it's very liquid. And when you buy into a REIT, you're buying into a portfolio of thousands of properties. And in today's video, we're going to continue our theme on top stocks for 2025. Today's video focusing on REITs, the 5 top REITs for 2025. So before we begin and unveil these 5 REITs, do me a favor, show your appreciation for the research by simply clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can go to fool.com/Mark to sign up to receive their 10 best stocks to buy right now. All right, let's jump back into our video unveiling 5 REITs for 2025, beginning with REIT number 1, which is going to be Vici Properties, stock ticker VICI. For those of you unaware, Vici Properties is the largest REIT holding within my portfolio. They have a great management team, an awesome portfolio of some of the best casino and hospitality properties around the country today. The company currently has a market cap of $31 billion, and over the last 12 months, shares are down nearly 10%. As I mentioned, Vici Properties is a hospitality and casino REIT with properties all across the U.S., but they are also the largest landlord on the Las Vegas Strip. They own some great properties along the Strip, which include the likes of Caesars Palace, MGM Grand, Park MGM, Mandalay Bay, and the Mirage, which is now being turned into a new state-of-the-art Hard Rock casino in the shape of a guitar. Vici works with some of the best operators in the world today, particularly in the hospitality and casino space. And there's less than a handful of REITs that went through the pandemic and were able to maintain a 100% cash collection rate. That means all the rent they were due all during that period, they were collecting 100% of it. That speaks to the quality of the operators that Vici works with. Analysts are high on the REIT, rating it a strong buy with an average 12-month price target of $35, implying 20% upside from current levels. In addition to the upside potential in the stock, as an investor, you also are getting a high dividend yield of nearly 6% and a dividend that has been increased every year the company has been public. In terms of valuation, analysts are looking for the company to generate 2025 FFO of $2.32 per share this year, which equates to a forward price to FFO of 12.7 times, well below their 5-year average of 16.3 times. This REIT won't stay this cheap forever. And that leads us to REIT number 2, which is going to be Equinix, stock ticker EQIX. If you've looked back over the past few years, the major theme and a big reason for the big stock market gains, that has been AI. Well, in 2025, AI continues to be a theme. However, investors are looking for different ways to play that AI theme. And there's a way to do this through real estate. And that's where Equinix comes in. The company currently has a market cap of $91 billion. And over the past 12 months, shares are up 21%. In a year when REITs did not perform all that well, the second worst performing sector in the S&P 500, EQIX, was a rare bright spot. And when it comes to investing in REITs, although I love ETFs and index funds for other sectors, the REIT sector, not particularly. I would rather invest in 5 to 8 of the highest quality and best REITs on the market today. And in fact, if you're interested in seeing my entire portfolio, you could sign up as an Edge Plus member and check out my monthly portfolio updates, get trade alerts, stock deep dives, and so much more. Check out the link to the Stock Investors Edge newsletter down in the description below. But getting back to Equinix, all this AI is taking the world by storm, but the fact of the matter is that these AI capabilities require tons of power. Where Equinix comes into all this is that they are the largest data center REIT on the market today, where companies of all sizes are clamoring for more space to meet power needs. Analysts are high on the REIT, rating it a strong buy with an average 12-month price target of $1,027, implying nearly 10% upside from current levels. The upside's not nearly as great as all of the others on our list today, so it may be a situation where you keep this REIT high on your watch list for any pullbacks. In addition, Equinix does not pay a huge dividend, but what they do offer is strong dividend growth. They currently have a dividend yield of just 1.8%, but a 5-year dividend growth rate of 12% and nearly a decade of consecutive years of boosting that dividend. In terms of valuation, analysts are looking for the company to generate 2025 FFO of $27.20, which equates to a forward price to FFO of 34.7 times, which is higher than the 5-year average of nearly 30 times. So again, not a cheap stock by any means, and one to keep high on your watch list here in early 2025. And that leads us to REIT number 3, which is going to be Prologis, stock ticker PLD. PLD is a name that I've mentioned on this channel a few times, and it's one I continue to like. In fact, PLD is the largest REIT on the market today. The one that follows it, the second largest REIT, happens to be Equinix, the stock we just talked about. In terms of Prologis, they have a market cap of $98 billion, once above $100 billion, but over the past 12 months, shares are down roughly 20%. And as you can see, looking at this chart, 2024 was a year of ups and downs for the REIT, which coincides with many REIT charts for the year. One of the major reasons for a lot of ups and downs we have seen across the REIT sector as a whole is due in large part that at the end of the summer here in 2024, we saw a lot of rate cut talk heading into the forecast for 2025, up to 5-6 rate cuts in 2025. Well, when that became more clear that wasn't going to happen as inflation remains sticky, the talk now turned to maybe only 2 to 3 rate cuts in 2025. And all the REIT gains that we saw in late summer, which was a top performing sector in the S&P 500, a lot of those washed away. Prologis is the largest industrial warehouse REIT, which is a play on the growth not only in e-commerce, but they're also looking to grow their exposure to data centers with more of their properties as well, which are 2 big growth areas moving forward. Analysts are very upbeat on the REIT, rating it a strong buy with an average 12-month price target of $129, implying more than 20% upside from current levels. Like Equinix, you're also getting some solid dividend growth, as they have a 5-year dividend growth rate of 13%, but in addition, you get a very nice dividend yield at 3.7%, giving you the best of both worlds. In terms of valuation, analysts are looking for the company to generate 2025 FFO of $5.80 per share, which equates to a forward price to FFO of 18 times flat. This well below their 5-year average of 25.6 times. And that brings us to REIT number 4, which is going to be Rexford Industrial, stock ticker REXR. We're going from one industrial REIT to another, except for Prologis was a very global reach. Rexford is very focused. This is in the state of California is where they have their footprints, but more specifically, Southern California. The company currently has a market cap of just $9 billion, and over the past 12 months, it has been a little bit rocky, like we saw with Prologis. Shares of Rexford are down roughly 30%. However, for long-term investors, this is a time to build positions in beaten-down stocks that are still high quality. The reason for the beatdown in this particular stock has less to do with the actual performance of the company and more to do with the macro environment, more specifically in Southern California. The commercial real estate area in Southern California has not been great by any means. In addition, even larger than that has been the rise in interest rates and the slowing cuts where we were expected to see in 2025. Rexford is one of the more concentrated REITs on the market today, being fixated on Southern California. CBRE did a recent study, as you can see here, showing that the vacancy rate in the region climbed nearly 4%, and the Los Angeles area in particular has reported 7 consecutive quarters of negative absorption, as supply has exploded, but that appears to be coming to an end. The 4% vacancy rate, though, is the highest in the region in nearly 15 years. So a lot of these headwinds that we've talked about are going to turn to tailwinds for the company in 2025 and on to 2026. Interest rates are going to come down. We saw a huge expansion in the LA port. Supply construction, that is starting to slow. And we may have seen a bottoming in the SoCal area. In terms of analysts, they're upbeat on the REIT, rating it a moderate buy with an average 12-month price target of $58 per share, implying the highest upside of all 5 stocks on our list today of nearly 50% from current levels. In terms of the dividend, with REXR, you get a 4.4% dividend yield and very strong dividend growth as they have a 5-year dividend growth rate of 18%. In terms of valuation, analysts are looking for the company to generate 2025 FFO of $2.52 per share, which equates to a forward FFO multiple of 15.2 times, well below their 5-year average of 33 times. So as you can see, there are still near-term headwinds, but this could be a time to start adding to this, slowly but surely building up your position over time. And that leads us to REIT number 5 on our list today, which is going to be Extra Space Storage, stock ticker EXR. What could be more American than self-storage? I mean, the fact of the matter is, here in America, people are hoarders. Whether you're upsizing, whether you're downsizing, people in America don't know how to get rid of stuff, which makes for a great business when it becomes self-storage. Exactly what Extra Space is, who happens to be one of the largest self-storage companies on the market today. The company currently has a market cap of $33 billion, and over the past 12 months, shares of Extra Space are actually only down 5%. In the midst of a down year for the REIT sector as a whole, self-storage has held up rather well, which speaks to the quality of this particular subsector, and I like to call it an all-weather position. The company owns 2.7 million storage units and nearly 300 million square feet of rentable space across 42 states, and more than 3,800 properties are within the portfolio. As I alluded to a second ago, people are hoarders here in the U.S., and that is evidenced with the percentage of U.S. households utilizing self-storage growing from just 5% in 2000 to more than 11% today. When it comes to self-storage REITs, the 3 largest on the market include Public Storage, Extra Space, and CubeSmart. However, although Public Storage is the largest by market cap, after Extra Space's merger with Life Storage, they are now the largest REIT by square footage. This is a sector to get steady returns on over the years. Analysts are looking for some more steady returns moving forward, as they have an average 12-month price target of $173 per share for EXR, implying 15% upside from current levels. In terms of the dividend, you get a nice juicy 4.4% dividend yield and 13% 5-year dividend growth rate. Looking at valuation, analysts are looking for the company to generate FFO of $8.30 this year, which equates to an FFO multiple of 18.2 times. This slightly below their 5-year average of 20.9 times. So from a valuation perspective, you're getting a discount compared to historical averages. But with that merger, that should command something closer to Public Storage's multiple, which is near 21.5 times. So there we just looked at 5 fantastic REITs. We have industrial REITs, self-storage REITs, data center REITs, and the list goes on. Down in the comments section below, let me know which of these 5 REITs would you most likely be investing in here in 2025. And if you haven't done so, please show your appreciation by clicking that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.